Hello, I'm Chris Davies, Director at Brooke Chartered Accountants. We look after the accountancy and taxation affairs of businesses and individuals from our offices in Newbury, Abingdon, Bangford and Swindon. I'd like to talk to you today about the benefits of family investment companies. Now, these are the rules as they stand at September 2020, but as the rules are changing all the time, do please check with your accountant before taking any action. Many people in employment or self-employment are interested in buying residential property, mainly as part of their long-term wealth planning. In addition, many consultants affected by the new off-payroll rules may be questioning whether they still need their company and what to do with the sum of money already in the company, in the knowledge that if they take that money out, they will have personal tax to pay on it. If an individual acquires a residential property as a buy-to-let, they will pay tax on their rental income minus expenses at their marginal rate, which might be as high as 40%, 45%, or even 60%. Since 5th of April 2020, any mortgage interest on the borrowings only obtained tax relief at 20%. Bizarrely, in some circumstances, it is possible that the tax payable exceeds the profit that the taxpayer makes each year. In addition, on sale of the property, a higher rate taxpayer would pay capital gains tax on the profit of 28%. Those taxes are payable whether the taxpayer spends the profits personally or is saving up the profits to acquire another property. Altogether, that is a lot of income lost through tax. Conversely, companies can claim full tax relief for mortgage interest paid and only pay tax on rental profits and the profit on the eventual sale of the property at 19%. Further tax might be payable by the individual if any is extracted from the company as dividends, etc., but whilst it's left in the company, perhaps to build up a fund to buy another property, no further tax is due. Rather than paying higher rates of tax by extracting income from the company now, it is often intended that dividends are taken from the company by the shareholders to fund their retirement at a very low rate of tax. So over the life of the investment, there can be significant tax savings. Not only that, but a company vehicle would allow ownership to be spread amongst family members, with perhaps some dividends being paid in a very tax-efficient manner to adult children, for perhaps their first car or their university fees and living costs. Now, no one likes to talk about death, but spreading the ownership can also help with long-term inheritance tax planning. If properties are held in an individual's estate, then on death it is very possible that tax at 40% will be due, and the properties will have to be sold in order to pay the tax, and the property portfolio is decimated. If the properties were held in a company, then shares could be transferred to children over a number of years prior to death to reduce the value of the taxable estate and consequently any inheritance tax payable. With careful tax planning, the property portfolio can be retained. I would like to touch on the subject of family trusts, but just to be clear that these are not necessary for the benefits I've already mentioned. I know that the word trusts can worry people because they sound complicated and there may be some connotation of tax evasion, but a simple family trust is simple to operate and there is no question at all of any dodgy tax dealings. If it is intended that the property portfolio should benefit future generations of the family, then the use of trust really should be considered. If you give the company shares to a trust at least 7 years prior to death, then the value falls outside of your estate on death, similarly on the subsequent death of your children or grandchildren. The property portfolio passes down through the generations without being disturbed by generational changes. I ought to mention that the trust is not entirely tax-free. For example, there is a 10-yearly tax charge, but the tax payable by the trust is a fraction of that which might be paid on death outside of a trust. As well as limiting inheritance tax liabilities, a major advantage of a trust is that it protects the family assets. For example, it would protect the assets from any offspring that might not be able to handle money well, or may fall into financial difficulty through no fault of their own, or from a claim by a future and as yet unknown ex-spouse or children or grandchildren. I have referred throughout to using a family investment company to acquire residential properties, as that is the most common question that we are currently being asked. But for the most part, the rules apply to other assets, for example, commercial property, stocks and shares, valuable art or wine. So in summary, with or without the use of a trust, family investment companies are very tax efficient, both over the short and long term. And we have acted for family investment companies over many years. So if you would like to discuss whether one would be suitable for you, please do get in touch. A list of offices and contact numbers will appear on the screen shortly. Finally, if you have found this video useful, please do like and share. Thank you.